looking forward to getting started here. We're running a few minutes late, but we're going to get kicked off anyway. Really looking forward to getting into our next panel with some awesome guests. The topic here is scaling institutional capital in Web3 finance. And we have an absolutely incredible panel. We're super lucky to have these guys on stage with us today. So without kind of further ado, I can hand it over to Mattia. But I think just an introduction of you and your firm would be a great start, and then we can really get into some fun conversations today. Working for you?
Works now. Cool. Hi, this is Mattia. I'm a DeFi trader at IMC. IMC is a traditional option market maker active on quite a bunch of exchanges around the world, mostly United States, Europe, and Indian market, stuff like that. They also have a branch in Zug, which is crypto focused. Mostly active on centralized exchanges, but a smaller part of the team works also on DeFi stuff, and here I am.
There you go, man. How cool is it to get paid to be a DJ, man? Fuck. Sounds awesome. Yeah. So my name is Juan David. I'm a co-founder of Keyrock. Keyrock is an algorithmic trading firm, market maker as well. Specialize in crypto, so we don't do any traditional finance. But in the digital asset space, we're quite large. We've been around for about 7 years, and we have a business line in market making as well. So we trade across DeFi protocols, perps, and so on. Treasury management. We have OTC desk, all of the likes. So we can definitely help in the overall DeFi ecosystem. Yeah.
Hey guys, I'm Jordi, founder of Selini. Selini does a little bit of everything. So we do DeFi, CeFi, venture, OTC, try to just do everything in crypto. We used to do TradFi, but now we cut it all out. We just focus 100% crypto.
Awesome stuff. Well, let's get directly into some of the questions. Excited to have kind of a very informative and kind of collaborative conversation. And the first thing, I know a lot of the folks who I have a lot of these conversations with are actually upstairs. So I'll be excited, for them to funnel down, but to report back to this. But the allure of market making is often quite misunderstood by outsiders, and it's so funny. In my time, you get the messages, this token's pumping, the market maker's pumping it, or X, Y, and Z is pumping it. And it's quite interesting to understand that that's usually not the case. So I wanted, for you guys really to set the stage in terms of understanding what is market making, and really the concept of prop trading versus liquidity as a service. And Mattia, if you want to start, we can, kick this one off to you and then, come backwards.
Yeah, so on the myth of market maker moving the market, I guess, as you were saying, it's something that it's usually, market makers in general tend to be very risk neutral. That's their entire business. They try not to take any risks. So pumping or dumping stuff, it's usually involves some risk taking. So usually professional ones, especially the one with certain reputation, tend to avoid those type of practices. And in general, it's just not probably that profitable if on average, let's say at least. So mostly a myth, and unlikely that people would leverage that and be sustainable long term, because eventually if there are certain actors that do those sort of things, people would notice eventually. So it's
So I guess you were asking what was market making, correct?
Yeah. I think many folks historically really feel as if a lot of the different market moves that are occurring are market maker driven, and I've largely found out through the past 5 years of my own personal experience that that's usually not the case, and kind of understanding what is market making and kind of what's happening really behind the scenes.
I mean, if you take a step back to what is market making before you go into market movement, correct? Market making is just literally the capacity for you to understand the price of something, and that's the core idea, correct? If you cannot derive and have an accurate understanding of the fair value of something, you cannot provide liquidity to it. But if you do, you'll be able to do it efficiently. Yeah. So, typically, the way that I look at it is that you have a spectrum in the level of maturity of a market. The more mature a market is, market making is more of a science. It's something that can be modeled, and it's something that can be structured in a way where it's predictable. And in that case, it's very easy to prove that a market maker doesn't have influence in the price because it's literally just reacting to other people's price, understanding of the price to create some understanding of the price. But the lower you go into the curve of maturity, it becomes more of an art. And there is actually not so straightforward to understand where the line is, because ultimately the market maker is not trying to take a directional position, but the less liquidity something has, the more influence the actor has on the market, because by definition you have a higher percentage of the dominance of the trading volume of the market. Yeah, it's the responsibility of the market maker to act in a way that is in the benefit of the market. But definitely there could be situations where if incentives are not aligned, something like that could happen, honestly.
Yeah, I agree. And there's a lot of people that use the term market making to mean very different things. And it can mean anything from like market manipulation, which some other three-letter firms do, not IMC. I'm not going to say which ones. And then you have, just quoting the book, which is also market making in a sense, because you're making the market. Very few people understand even the differences between these things, and tokens and token founders are always looking for, it's like astrology. You try to understand, like, why is it going up? Why is it going down? And you start imagining things. Usually it's just market makers are supposed to smooth out demand. So there's a lot of demand at the launch, and then there's not a lot later, and they should try to smooth out the curve so they don't look schizophrenic, because unfortunately, like retail traders, when you aggregate them, their behavior is very herd-like, and the herd-like behavior on a chart looks schizophrenic. So ideally, a good market maker just sort of smooths out demand and supply over time. That's like their actual job. But yeah, the term is loaded, and it can mean different things, unfortunately.
Totally. That's awesome. So now with that kind of foundation set, posing the question to you guys, to tell all different types of founders that are here with us today, assuming you were in the shoes of a founder, what would you look for in terms of a potential market maker and in terms of a potential deal structure when launching your token, and approaching a TGE?
Yeah, I mean, what I've been telling founders is just keep it simple. The more you try to over-optimize and get 10 consultants and, add 20 parameters and all this stuff, it's counterproductive and just adds a lot of unnecessary headaches to everybody to try to figure out what's going on. And then you add these like weird misaligned incentives sometimes, because you put parameters that are gameable. I think it's quite simple, and I think the industry is starting to realize that. I mean, the right thing to do is just find someone reliable that has the technical expertise, they have the technology. Most market makers don't even have the tech, and you can see like who's trading on Injective, who's trading on DEXs, like who actually has the technical know-how to be able to provide liquidity and do it efficiently and not get run over. And then just have someone who's communicative and can explain these things. That's it. Very simple.
I mean, from our point of view, I mean, founders, they try to create all of these parameters, the so-called SLAs, correct? So you would have the intention of modeling what the service of market making should be. But the reality of it is that the best advice that I can honestly give any founder is to use fair market competition. There's actually nothing better than that. You just literally hire a couple of market makers and you give them a fair structure in which they can compete with each other without anybody having any advantage or strange incentive. And then you measure market share, and that's it. Like, literally the market is the best one at telling you how to optimize your liquidity. Because ultimately, like, no matter what an SLA does, if a market doesn't have adoption, it's going to be impossible for the market makers to actually hold a spread because there's nobody there. And if the market has a lot of adoption, maybe the SLAs are too light for reality, And if there is real competition, you're going to find that sweet spot where you actually manage to get the liquidity that is right for the demand of the market. So somehow, I mean, at the end of the day, it's really just following the principles of the market. And if you do, you have a great liquidity.
I just agree with the keep it simple and fair philosophy.
Totally. Awesome stuff. Well, I think that's much appreciated for anybody listening that is interested. So for the next piece, I want to get into what excites a trading firm in the world of crypto and the world of digital assets today. Some things that come to mind personally, right, are where is the retail flow, where is the price discovery happening, and lastly, all these new and exciting structured products like basis trades, Athena, et cetera. So kind of wanted to open it up, this second question to more of an open forum to understand from your guys' perspective where, what's exciting in the world of crypto today and where is it happening?
Maybe I can start on that. So what I found particularly exciting, maybe a shout out on Injective, is the fact that you guys are having something a bit trying and develop something a bit different than other limit order books that are currently at least aware at a big scale on chain. So the fact that you guys have an FBA structure that is quite interesting because it's something that is, even in traditional finance, that's something that's been studied academically. It can help with the, decreasing maybe some latency war and side effects of classical HFT, which are not, the best and could be, resources that could go somewhere else. So that's something quite interesting, and I personally like quite a lot. There is also other stuff in the, the real decentralized limit order books, which excites me a bit. So, for example, shout out also to DYDX that has a decent, decentralized limit order books. They have their own issues with the fact that probably if you run your own node and the validator is running a different one, and your strategy rely on a good, unique version of the order book, your order book may not only be delayed but could be completely, incorrect. That is not optimal for traditional market maker or people that are used to like event access, because it may mess up some of your, let's say, strategy and stuff like that. But that's another solution. Like it's just a trade-off and stuff like that. So that I quite like, and those I see as potential trade-offs that can potentially converge to a more decentralized and actually, on-chain limit order books, which is what we actually want. And also the solutions that are currently on Solana, those are also quite interesting.
From our side, we've been analyzing new primitives that we think could make sense. Of course, outside of the continuous growth, of improvement of the current drivers of adoption, which are perpetual markets at the moment. If you look at the volume right now, in terms of derivatives, it's predominantly perpetuals, and in terms of spot, it's predominantly liquidity pools and solver models. That's basically where the market is today. Towards the future, it's hard to tell, but what we think is that AMM derivatives could actually potentially work. So like the capacity for you to build derivative products on the back of markets where you would trade liquidity ranges. I think it could actually bring a value proposition to traders that would be very interesting. Interest rate swaps. I think could potentially work because they are very similar to perpetuals, but then it's like a perpetual of a rate. And that could be very useful to allow people to fix their rates. So imagine like you would go to Aave and instead of lending at 10% USDC on a variable rate, you could say, okay, I want to have a fixed rate and for 6 months, similar to when you take a mortgage to buy a house. Like majority of people that are not traders, they just like predictability. So that's also something that could potentially make sense. And then in terms of like just these specific markets that we have right now, I like a lot all the movement that's happening right now in terms of like open vaults and the capacity for market makers to basically expose their intelligence so that everybody else can enjoy better liquidity without impermanent loss, let's say. Overall, I think those are major drivers that we've been analyzing, and I think they could make sense.
When you say vaults, you mean like you create a strategy, like a solve or something, and then people put money into it, or what do you mean?
Yeah, kind of like, like you would, so vaults as an intermediary for like money managers to expose their intelligence for other people to put money in them, And
would the vault manager be like a regulated, like a real firm, or would it just be like a small, decentralized?
It depends on the strategy. If you think, for example, a very basic vault, like say basis trading, like Athena is an example of that. if you have a DEX where you have a spot and perps, and you have variety of spot, so you can actually cross margin against the perps, you could run like some bolts that are just smart contract strategies where you just go 5x leverage spot, 5x leverage perp, and hopefully you collect the yield, and at least you're not exposed to potentially a thing like imploding, correct? And it's fully centralized.
Are you seeing that being open for market making firms or trading firms to do, or is it just the protocol itself has to sort of? I guess there's.
I think there would be a lot of demand from the protocol for managers, in this case, predominantly market makers, to build that technology. There are already some initiatives of this. I mean, if you look at, for example, Hyperliquid or even for example the Solana ecosystem, if you look at Drift as well, it has not happened yet, but there is a lot of information in terms of the community forums that say that if a market maker would want to build a strategy, they would be willing to help with the build. And I think it makes sense. I mean, ultimately, market makers have majority of the know-how, and I think in terms of demand, of course, delta neutral strategies are very important. But I actually think majority of retail the real demand is actually not on delta neutral strategies, but it's on high Sharpe ratio strategies. People in retail markets are actually looking to take a little bit of risk, as long as they can optimize return, and that's what's very hard to do for them, because to build strategies that kind of make sense and make revenue under majority of market scenarios, but maybe have a little bit of risk, is something that you need a real manager to be able to do. And I think there's a lot of demand for that to deploy liquidity on. And at the same time, that would then be a way for order books to have more liquidity and so on. So that's interesting.
Yeah, I mean, I agree. Like, it's an exciting vertical. These vaults and Hyperliquid maybe is the first one that really kicked it off. And since they were a trading firm, they had the know-how to do it. I think the regulation is one of the challenges there, because you're in essence, you're running a hedge fund.
You're offering an unregistered hedge fund to retail users.
And Ethena is the same thing. I mean, that's what it is. It's just, and then you start getting into like, how much money can you make? What kind of legal bills are you going to have? Like all this kind of stuff. So I do think it's better for everyone, as long as, I mean, the regulation is there to avoid, people getting scammed and like rug pulls. And we have had things in crypto. I remember like Virgil Capital from last cycle. I don't know who was around then, but like this was a fund that was taking LP money from everywhere and saying that they were making consistent returns. It was like a Madoff thing. They'd never even done a trade. Like they were just, buying mansions in Australia. So.
What was the return on those mansions, though?
Yeah, like, it never ends well for anyone. I like the vaults. I would love to, as Selini, just make a bunch of vaults and have people put money in. And, it's not going to be our main core HFT strategies, because, those are limited capacity and they make, 50 to 200%. We're not going to let anybody in those.
It's for a different target customer,
different target, here's a 20% strategy, compound your money over time.
And for majority of retail, that's just fantastic, correct? It's just brilliant.
Yeah.
Spend my money, and at the same time you build healthy liquidity. Right now, what we have in the market is very dysfunctional. You have billions of dollars in all these liquidity pools where people don't really understand the risk they're taking, and they're just basically losing money like idiots.
I agree. And then on the basis thing, basis is such an interesting thing. It's like such a interesting concept. And even the amount of the basis is this weird formulas. And I think Binance or one of the exchanges just decided that it's going to be the neutral one. It's going to be 1 BIP per window. Just came up with it, which ends up being decent. It's like 5% a year, 6% a year. And so even if things get matched evenly and the demand is even, when I say even, it means that the spot and the future are trading at the same price. There's still some basis for being short, for being delta neutral. We're still in this world where people want leverage and they're willing to pay for it. So basis has compressed, not just from Ethena, but some of the other, very sophisticated hedge funds that are looking at crypto. They will deploy $1 billion into basis trading, because for most hedge funds, if they can make 10% a year consistently, that's like a big success. So basis has compressed, but still exists in different dexes in different places.
It's becoming some sort of like the base yield of the industry somehow. I mean, like we look at it as like anything that doesn't beat the basis, like why would you even build it? Like,
Yeah.
stop building it.
Totally. It's kind of like the new risk-free rate to some extent, right? And back from an injective perspective, the vaults are very interesting. It's something we've looked at for over several years now. And it hasn't been a technical kind of hurdle for us. It's been our GC's hurdle for us. So very interesting to hear that as well. Getting into the next major topic that I think I would love to spend the most time on is really centralized exchanges versus decentralized exchanges from your guys' perspective, and really being that main liquidity source on many exchanges across the board, the three of you, primarily, and wanted to understand, what will it take to truly get DEXs to where SEXs are today, right? I think it's no mystery that obviously all the retail flow really remains on the centralized exchanges and things like Binance, et cetera. But from your guys' perspective, which I think is a very unique one, how do you think that a decentralized exchange or any decentralized exchange really, gains market share in the coming years?
Maybe I can get started with that one. I mean, I think overall, there is something that DEXs cannot control, which is the adoption of Web3 or the speed at which the adoption happens. There is a learning curve that needs to happen where people need to understand how to use a wallet, and everything that can be done to abstract that is going to help to make it look and feel more like a Web2 solution. But ultimately, I really think the driver of adoption is just the speed at which that transition happens. And it's accelerating. I mean, honestly, like I am not anymore in a position where I think that SEXs are light years away from DEXs. I actually think they're catching up very fast. Like it's already happening. Like if you look at the centralized universe, honestly, outside of the top 3 exchanges, they are really struggling compared to what's happening in DeFi actually. So yes, you have Binance and OKX and Bybit. And maybe in Europe you have a bit Kraken and then Coinbase, and then outside of that, it's a struggle, honestly. Like it's not like it used to be in the past. And then on the other hand, you have more and more DEXs that are doing 100 million plus volumes consistently, and it happens more often. So I think the transition is happening, and it will. I give it 3.5 years.
Tricky question. It's a chicken and egg problem because user wants liquidity wants user, so pretty tricky. I guess if I were in your shoes, I would. It's a bit of a bias take, but of course that liquidity costs because there are incentives to keep the liquidity there. Try to attract as many users as possible. That helps. And maybe the sophisticated ones care about costs of the execution side. Probably they don't care that much. If you look at the general AMM execution prices, they're not looking that good. People don't seem to care, the one that are currently trading there. But maybe eventually other sophisticated actors will be there and they drive adoption and stuff like that. But it's pretty tricky. So I would incentivize with fees, maybe just try to compete with them initially on that side, and then on user experience. That definitely helps because especially the retail side doesn't want. And maybe also one fact that is a lot of times underlooked is the on-off ramps, because people can more easily get off Binance and centralized exchanges rather than something on crypto. They maybe need to breach some other chains and then go back to a SEX. So again, goes back to user experience, but a very big pain point on that.
But bridging is also getting so much better. It's actually incredible. Like 6 months ago, it was an absolute pain in the ass. And also since the release of all the bridging technology of Circle, people are starting to get used to the fact that, they can move stable coins between chains, and it's bringing a lot of understanding and fear that used to be on bridging. It's going away. So that's helping a lot already. Like I see a lot of protocols now and centralized institutions natively on the back end just using the bridging technology to help their Web2 users. So I think it's very close, honestly, even from the bridging side.
Yeah, I agree that it's getting a lot better. There's more omni-chain tokens. There's more kind of free transfers. There's more native chains with USDC, USDT, etc. So it'll get better. I think DEXs will have more tools on the tech side. That's really the main downside, is just the tech side on DEX is just a lot harder to do. The user experience, I think, on the login and the key management is getting incredibly, it's like the only thing that I'm excited about right now. It's just seeing, I went to the conference and saw some of there's a lot of people using passkeys now and just like face scanning. I think Infinex is leaning into that, and a few other apps are like trying to avoid users having to deal with keys for being able to trade on chain. And I think eventually that will create a much better user experience. The other thing is just, as a trading firm, we hate unreliable matching engines, busted trades. You think you got a trade, and then ghost positions just appear. There's a lot of DEXs that don't really have the smooth operational side, and that adds so much unnecessary cost to providing good liquidity. So I agree. Like, bridging is getting better. Things are getting better.
But on the quality of the APIs, I think if you look at, I mean, I don't know what has been your experience on this, but even on the centralized exchanges, 3 years ago, they were so bad, the APIs, even of the top exchanges, they were miserable. Like 4 years ago, the API of any of the top exchanges was garbage anyway. So like the speed at which APIs improve with user feedback, because ultimately like we are all just users of DEXs, and every time it breaks, you know, you just go on Slack or you go on Telegram, guys, this broke, and they'll fix it, and they'll make it better. And like, when I look at the speed at which APIs on centralized exchanges improved, because again, when you compare them to TradFi APIs, they were absolute garbage, and honestly, they still are. Like, so I think it's gonna go also really fine in terms, if DEXs take the feedback, they integrate the feedback, I think it's gonna work.
Totally. And with that being the case, I think another piece of it that I wanted to get into is Injective. You know, I guess 6+ years ago was the first ever Binance Labs incubation project, and the whole promise of what Eric was looking to build was a decentralized Binance. And really, when you look into a lot of the core tenets of a lot of the stuff that was written all those years back, was the concept of smart contract risk versus credit risk, right? Keeping your funds on a centralized exchange, as we saw with FTX, as we saw with many other things, have credit risk to, you know, the centralized exchange, and you offload that kind of credit risk to smart contracts in a more decentralized version, obviously creating a much, you know, to some extent, you know, user experience that's not necessarily on par, but kind of, you know, would love to hear from your guys' perspective how you feel about that concept of smart contract risk versus credit risk, and how you think that conversation is evolving, you know, between some of the things we're seeing at Bybit right now, some of the things that we hear about Binance on a daily basis versus the funds that you guys keep on chain.
Funny enough, if you look at Binance, I mean, like, so you guys were a Binance Lab incubation, correct? But Binance itself, if you look at the white paper and the ICO, it was to do Injective, basically. You know, like their first version of their fundraise was for a DEX. Like that was the vision. And then they realized that the technology was just not there. And therefore, I mean, I remember back in the day when I was talking with them at the very beginning, the story was like, this is how we go to market, this is how we develop it. And at the time, Binance was a very small exchange. And then later on, when the technology is more mature, we'll go on chain, correct? And of course, that has not happened. I mean, they did create the BNB chain. But the point I'm trying to make here is that it's a matter of incentives, correct? Like, once you already have a customer base that you can monetize, it's so hard to just say, I'm gonna let it go, and then completely like lose your capacity to monetize that customer. I mean, like even without going on chain, the problem of credit risk is not a blockchain thing. Like in traditional finance, exchanges are not custodians, and there's no blockchain. There's nothing to do with that, correct? And in our industry, Copper and Fireblocks and of the likes have pitched Binance and Bybit to build non-custodial trading for traders like us, and the exchange says no, because they don't want to lose power. So it's nothing to do with the blockchain, unfortunately. It's really just like a matter of protecting your business. And for a company like you guys, you started already with a separate mindset. So it's much easier to like continue in that way and like relying on custodial technology. Right? So that's great.
Yeah, I mean, I don't want to be too contrarian, but I think it's kind of been proven that the benefits of doing a DEX are not about the custody. Custody stuff, honestly, is just like a bit of a red herring. It's a tail risk, but even on-chain stuff has tail risk, like random crazy hacking stuff. You know, we've seen Curve have issue because like some code on, like just crazy stuff has happened. You know, Wintermute had profanity stuff where like too many zeros and then people figured out their keys. There's so much random tail risk, and as a trading firm, we're not going to keep all our capital in one place. We're just going to keep trading capital. And the centralized exchanges have learned their lesson, I think, at this point after FTX, not just through like the on-chain proof of reserves, but actually a lot of them are accepting third-party
because
custody
they
now.
see it as a way to compete with the ones that are dominating the market, correct? So you first have the tail of exchanges, the smaller exchanges, they start accepting all of these technologies. And ultimately, it's going to happen, correct? But the ones that have the bigger part of the cake, they are the ones that are not accepting it too much. Like if you talk with Coinbase and Binance, the conversation is a lot harder than with a smaller exchange that is looking for a differentiation factor.
I mean, there is a maturity level at this stage of the industry, so I think that thesis is wrong now. It doesn't play out anymore. At this point, I'm not worried about Binance rugging, OKX rugging. Like, these guys have made billions of dollars. They don't want to fucking go to jail. I meet all these CEOs all the time of all these top exchanges. They just don't want to go to jail. They're set. They're not going to risk something going wrong. Now, might they get hacked? Like, that's always a risk. But like I said, that's a risk with anything. So intentionally, I don't think we're going to have like another FTX. Nobody wants to follow that path. And we see it with Tether. Like, they've made so much money. It's not like this thing's going to depeg. They have a cash cow. The cash cow, they just wanted to keep it running. So the main benefit of a DEX and like Web3 is really having token rewards, building a community, like sharing the upside of the success, building these like vaults, like having these kind of products. And I think it's a lot easier to do that on DeFi. So I would focus on that now rather than it's safer.
I agree.
Yeah.
Exactly. Yeah.
Totally. Well, getting into really, the last major piece here is kind of the crypto incentive conundrum. And I think you really just brought it up there at the end. I think we see many DEXs that are coming out today. And I think many just, new layer one blockchains that, fully build their entire narrative around points or around an airdrop or around essentially giving away free money. And in many cases, they're giving that free money to, trading firms such as you guys. And I would love to hear your guys' take. It's a very interesting kind of, way to look at it of how long that's going to last, where that's going to go, and how, you see this concept of giving away free money to get users really playing out in the world of crypto, I guess DEXs specifically.
Yeah, I've thought deeply about the pipeline of the free money and who gets what.
It's not free money, man. It is not free money.
It is in essence free money in the sense of like incentivized activity. But there's a few layers. You're right. So first of all, like look at DYDX. They were the first ones. They put some incentives out there. Market values them at some amount. Main thing is, most of it does go to the protocols because the trading fees that they generate, we're competing and we'll compete to zero. So if there's, 99 cents to make, we'll give back 98 cents because we'll trade at a loss to get the tokens that, we value at something. Obviously, there's a little bit of like spread ultimately that will get made, but if Paradex or somebody has like, $1 million a month of incentives, the trading firms will pay 990K of fees to get it. So it's not free money in that sense. At the end, there is some free money, and it appears because theoretically, at the end, there will be some winners. They will create the infrastructure, and there will be There's venture firms that are willing to make bets on eventual infrastructure winners. There's a bit of a scale thing, so there will be like some economies of scale for incumbents that kind of manage to establish themselves. And the pipeline goes like, you have venture firms betting on this like tail outcome of who will be the decentralized Binance, and they'll subsidize some incentives, which we'll pay for, and everybody will get a little bit. And if the user experience is good, once the airdrop ends, I mean, we're seeing like DYDX v3, surprisingly still has users, even though there's no incentives anymore. So this is the golden goose, like it's actual product market fit. I think others can have that. I mean, Uniswap, it's kind of in the middle because they don't have token incentives from their token. So you could say that that's also product market fit. So long-winded way of saying is, yes, a lot of it is just airdrop farming, and if the product is not good enough, it will go to zero after because everybody will stop using it, it will get dumped, and then some of them that make it, it will all make sense. Like, yes, that was the reason why it was being incentivized, and it's a good enough product to sustain.
I mean, ultimately, I don't think it's going anywhere because the idea of sharing value creation with early adopters is actually a great idea. Yeah. So that's not going anywhere. And the reason that it's not free money is that because for every injective, there are 20 ugly ducks. And the thing is that if you farm a token that is worth nothing, it's worth nothing. But what people don't see is how much it costs to do this. When you're like a retail person that sets up like an AWS bot and you try to farm something, fair enough, it costs you your time. When a trading firm decides to start trading on Injective, it costs $500,000. Like it cost of opportunity of developers, of quants, capital, time, and it is money. And if you invest that money on a protocol that doesn't become a success, you lost because you could have built an integration to something else that could have made you money, or your developers could have been building something else or a new algo or whatever, correct? So it is expensive. Like trading firms, every decision that they make, due to also like the high quality of talent that they have inside, they are actually.
It's interesting, the $500,000. Like I have an even higher like cost internally. I tell them like if it's not like the opportunity is not $100K a month, like I don't want to even look at it at this point.
Exactly, that's my point, correct? That's my point. Like if you. So you think, okay, this is free money, but it costs money to get that free money, so it's not free. So indeed, like when we look at something, if it doesn't make like $100K a month, you know that it's going to be a waste of time.
These guys like Mattia over here, they're not cheap. Like these guys.
No, I'm just thinking I'm going back to IMC and asking for a raise, but yeah.
He's expensive, man. He's very expensive, It's like every time that he clicks a button to put money on a Uniswap pool, it's like 10K, man.
Totally. Well, I think we're running a few minutes over, and I really appreciate you guys. We could go all day. I definitely, would love to get into the topic of meme tokens specifically here with Jordi to figure out what's going to pump next. But sadly, I think we're gonna have to come to a close. I really appreciate having the three of you on with us today. We're looking forward to building a great partnership with Injective and all three firms in the future as well. So thanks, guys, and looking forward to welcoming our next panel here almost immediately. Cheers.
Cheers.